Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hi everyone, I'm Ed Gotham and welcome to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Today I welcome Jesse Felder, founder of the Felder Report. Jesse began his professional career at Bear Stearns and later co-founded a multi-billion-dollar hedge fund in Santa Monica, California. Today he manages the Felder Report from his home in Oregon. Jesse runs a really fascinating blog at thefelderreport.com, and I've dug into some of his more recent musings on the market, including why it's time to get greedy in the energy sector and the vampire squid that's potentially behind the recent call buying frenzy in Tesla, sending its share price rocketing. Enjoy. Hi Jesse, great to have you on the show. Thanks for giving up your time. How are you today?
I'm doing great. Thanks for having me on the show. I'm excited to have this conversation with you.
Now, you've got a podcast. I've listened to a few episodes recently, Super Investors and the Art of Worldly Wisdom, where you talk with a number of very experienced, successful investors and traders. The goal being to try and distill down sort of what makes them so successful in the financial markets. I was interested to know what common traits, if any, have you seen whilst interviewing these people? Was there any themes that came up?
Yeah, I think the main thing is that everyone that I've had on my podcast has spent a good deal of time studying different strategies or techniques in the markets, and they've found something that resonates with them, and they've really kind of built a unique expertise in that area and been committed to it for a period of time. And I think that's really the only, or I guess the main common denominator among them is that they have a unique process in the markets, and they've been able to commit to it through thick and thin.
And how important do you think this sort of finding your niche or what have you through experience, I suppose, is that sort of essential as what you're implying to being successful in investing, etc. Finding something that works for you is pretty important.
Yeah, absolutely. I think it's probably the most important thing. I think one of the mistakes, the big mistakes a lot of investors make in the markets is trying to adopt somebody else's, process, even though they might not believe in it completely. And the reason they probably don't believe in it is they haven't done the legwork to really, research it and find out, why they should use it and believe in it. A lot of people just end up trying to piggyback on other people's work, and I think that's just kind of a dangerous thing to do, because when you do go through difficult times, and you're going to go through difficult times, you have to have that faith in your process, and that faith comes from experience and understanding and all those things.
Yes, yeah. And why do you think it is that it's very difficult for people just to copy and paste something else? Is it the psychological aspect that, like you were sort of implying there, they have to find something that really resonates with them as an individual, and not every individual is different, and therefore you can't do the copy and paste, because something like someone might have a really high risk tolerance and can place big bets or whatever, but others can't. This sort of thing.
Yeah, I think it's when you look at what a lot of different strategies. Obviously, every strategy goes through good times and bad. And what you find with, investors piggybacking on these strategies, they kind of just like to trend follow, essentially, invest in the ones that have done well over time, and, uninvest or, sell the strategies that, haven't performed. And so, probably a good example of this is, in 2007, prior to the financial crisis, and really, over the last few years, it's been really difficult to get anybody interested in, any type of hedging strategies, short selling or, tail risk hedging, anything like that. But then in 2009, after the financial crisis, that's what everybody wanted, right? They wanted to pile into tail risk strategies, tail hedging strategies. And so, and that was the exact wrong time to do that. And so I think that's probably what people do with all types of different strategies is, you look today, probably people are abandoning value investing in droves and for passive, which is essentially, in my mind, a momentum strategy. And this is probably the worst time to abandon value. Value probably is probably the most attractive time to be a value investor in a long, long time. And so I think that's just kind of people's human nature is unless you believe in the strategy and understand it, your human nature kind of drives you to do the wrong thing at the wrong time.
Yeah, that is very interesting. And as something, this contrarian point of view, it's something we'll pick up on quite a few times later on in a few of your articles are sort of focusing on that area, which is, I suppose, the going where the place where, everyone else isn't is sometimes a place where the biggest returns can be had, I suppose. I just wanted to get a bit of more insight about you as a person, your career. Could you give us a brief overview of your sort of financial career to date?
Sure. Yeah. I went to work straight out of college. I got a job at Bear Stearns in their Los Angeles office. And I essentially started out just running trade tickets. So between brokers and the trading desk. And I found somebody at Bear, though, who was essentially running a hedge fund within Bear. And I went to work for him, and it was kind of like an apprenticeship where I got to learn the ins and outs of his strategy, which was kind of a value-based discipline, but also with a heavy emphasis on following insider activity, buying and selling. Eventually, we left to form our own hedge fund in Santa Monica, and I did that for several years before I was head trader, co-portfolio manager, and whatnot. And that was through the late 98, 99, 2000. So right during the peak of the dot-com mania, I had kind of a front row seat, which was fascinating. But I left the hedge fund literally in March of 2000, right? Within maybe a week or two of the peak of the NASDAQ bubble, and moved here to Bend, Oregon, where I live now. And I've essentially just been managing my own money, writing about the markets, ever since.
Awesome. And during your experience with the hedge fund that you co-founded, is there any major takeaways that you sort of learned through that experience that has helped your trading, investing now?
To distill it down to one thing, that's tough. I mean, I learned so much, but I think probably the main thing that I learned was during a mania, it's very difficult to kind of keep a level head. I watched that, part of the reason I left the fund was my, co-founder was, we had a value discipline that was our mandate, and he decided to, put a lot of it, kind of abandon that value discipline and put a lot of money into a lot of these high flying tech stocks. But, to watch, just droves of people literally quit their day jobs and day trade, become day traders full time. And then even, my partners at the firm kind of lose their minds, for lack of a better description, as a part of this mania was really kind of astounding to me. And, it just makes me think of a quote. I think it's JP Morgan. I'm just going to paraphrase. It's, nothing so undermines an investor's rationality or psychology than watching his neighbor get rich. And that's just what manias do to us. It's so difficult to watch people get rich. And I saw that again during the housing bubble, five or so years later. And I think we're watching it again today in certain respects.
In just the housing bubble, or would you say that was having a similar sort of time in terms of tech prices, this sort of thing? Do you think we're having a bit of a bubble there, or there's so many people have different opinions on this, but what's your opinion on it?
Well, I think in terms of the stock market, we're absolutely in the midst of another, maybe, a speculative mania that's bigger than anything we've seen, going back prior to the dot-com mania. You look at what's going on in the options markets, as a function of, the lockdown and so many people opening Robinhood accounts and just day trading. And then you look at the volume in the options market, that's the most speculative side of the equity markets. And it's literally off the charts. The amount of money being poured into call options that expire in a week or two, and all geared towards the highest, risk names in the market, most highly valued names in the market. To me, that's a very clear sign of another mania. Is
this slightly different to before, where obviously interest rates are at rock bottom? Do you think this sort of like structure, equity prices will be supported at these levels going forward, or are we inevitably going to see some sharp pullback similar to the sort of tech bubble in the 2000s? Well,
I think George Soros has said that every bubble, every mania is driven by a misconception, a common misconception. I think what's driving this one is the Fed and the idea that the Fed can prop up the markets indefinitely. But I think when you look at what's really going on in terms of liquidity, Stan Druckenmiller has talked about this, recently, is that the Fed is literally just trying to soak up the massive issuance of the Treasury. And, QE up to this point over the last 10 years, when the Fed has been printing money to buy up Treasuries, it's reduced the supply of financial assets. So reduced supply supports prices. But QE today, I don't really call it QE anymore. I think it's more just standard fiscal dominance, where the Fed is being tasked with just soaking up the excess supply of Treasuries. So that's a little bit different. Actually, it's dramatically different actually than the QE of the past. So the supply of financial assets is actually expanding, and the Fed is doing what it can to try and mop up some of that supply to prevent a collapse in prices in both Treasuries and in equities. And so I think that misconception that the Fed can prop up the markets is an important one, because I think at some point, if the Fed does print enough money to buy up all the extra issuance from the Treasury, the dollar is going to tank, and then the Fed will be faced with a situation of trying to protect the currency or protect the markets. And I don't think they'll be able to do both.
Yeah, I see that. Do you think there's going to be a requirement for more activity from the Fed from these levels to see the US dollar go down more? I mean, it's fallen, but it's gone through a sort of consolidation period over a recent month or so. Do you see that continuing without more support? Or
I think actually in the short term, the dollar could probably rally. We've seen, in the futures markets, you've seen huge,
too heavily one-sided.
Absolutely. I mean, too many people betting against the dollar. And, I think it's the, long euro positions that have gotten, just massive. And so usually you probably have to unwind that trade to an extent. There's also, the fact that, the fiscal side has, been put on hold. And that's probably short-term bullish for the dollar.
Yeah, I see. Okay.
So
if the dollar does crash, what does that mean for stock? Because stocks, commodities as well, it would tend to support higher prices there. Do you agree with that, or what do you think?
Well, I think probably what a dollar crash would be pointing to would be a big part of, if you look at, the trends of the last 10 years, right? You look at U.S. equity outperformance versus the rest of the world has been greater than anything we've seen before in history. The dollar has been very strong, since 2011, 12. And, all of those kind of trades go together. Interest rates have come down. And I think probably what we're headed towards now is a stagflationary environment here in the U.S. The Fed has said they're hell-bent on creating inflation, and a declining dollar would also be inflationary. Rising, inflation and rates is not a good thing for the equity market, right? You have, risk-free rates rising. We've actually seen that to a little bit. I mean, look at interest rates have just risen a little bit over the last couple of weeks, and we've seen the market, really sell off kind of significantly here this week and over the last few weeks.
This is in bonds.
Right. Yeah. Well, but the rising interest rates, falling bond prices has meant rising competition, for equities. And so I think that's part of what's going on in equities, starting to struggle over the last couple of months.
Okay.
And so I do think we're probably headed for a stagflationary environment. So a lot of people who think, a dollar crash would be bullish for stocks, I think that's probably dead wrong, because it probably entails rising interest rates, which are not a good thing for equities.
Yeah, very interesting. And what about in the commodity markets? I mean, you've had a post recently about gold, trying to ascertain if it's too expensive at the moment. Can you go into a little bit of detail on that?
Sure. Yeah. I mean, I think long term, I'm very bullish on gold, and I think gold probably has plenty of upside ahead of it. You look at past bull markets in gold, and history would suggest this bull market's only just getting started. But in the short run, like I said, I think the dollar could continue to rise a little bit in the short run, and gold's probably gotten a little bit ahead of itself. If once inflation really starts to take off, that's when gold will really start to take off. But I do think we probably are going to muddle through some disinflationary months here potentially, just as a result of the dramatic drop in GDP and some other things, and demand in a bunch of areas. So, I think in the short run, I'd be a little bit more cautious towards gold, but long run, I'm definitely, very bullish.
Yeah. And are you able to, in the post, you talk about the major drivers of gold, and I thought it was really interesting, related to, I believe, fiscal related activity. Are you able to describe that a bit? I thought it was a pretty interesting thing.
Sure. I think, long term, I think, there's all these people look at so many different drivers for the dollar, but I think longer term, it's really the U.S. Fiscal situation that I believe is the driver of the dollar. So, the deficit widens and the dollar declines. You just look at least 25, 30 years of history, and there's a pretty close relationship there. So, that is all right. Dollar declines, that's very bullish for gold. And so really you can kind of cut the dollar out and look at what's the fiscal situation in the US, and that should tell you whether you want to own gold or not. So when the deficit is very wide or widening, you probably want to make sure you own some gold, because that seems to be an important driver. You look at when the last time we had a budget surplus in the US was 2000, peak of the dot-com mania, and that was when gold bottomed. The deficit started widening out as a part of that recession, and that began the gold bull market from 2001-2 until 2011. That 10 years of really the deficit going from zero to $1 trillion deficit was really the kind of the underlying tailwind, I think, for the gold price. Now we've seen, when Trump took office, we had a $300 billion deficit. He took it to $1 trillion, and now it's $3 trillion. That is a very strong tailwind for gold prices going forward. And if there's not the impetus in Washington to do anything about the deficit, then it makes sense to just hold your gold.
Yep, no, that makes a lot of sense. Really interesting. I've never. It's the first time I've seen someone sort of relate the gold price to that sort of indicator. But it makes so much sense, and it's really interesting to get that sort of angle from you. Something, obviously, the US election's coming up soon. Probably a pretty high period of volatility. Something that as a post you talk about mastering the art of doing nothing, which I thought was quite a good time to discuss it. Why do you think this is a good tactic to have in sort of your arsenal as an investor?
Well, when I've been really, since I've been interested in finance and the markets for a long time, and studying the greatest investors, of our time, and really, back before our time, you find that, I mentioned earlier, they all have a certain discipline that they stick to. Part of that discipline is when there is no opportunity, or really not attractive opportunities, you have to be disciplined and discerning. And I think that really the only thing that separates the best investors from the rest are they are just much more discerning. They don't see things that they think this looks attractive. I'm going to put some money into it. They wait until something is so attractive that they can't resist putting money to work in that way. And so I think that if you just wait for those types of opportunities where you say, like, just pretend you're not an investor at all most of the time until you something comes along and you say, you know what, I have to, this is so attractive. This is such an incredible opportunity. I have to put some money to work here. Then, your batting average, I've been watching the World Series. I'm a big Dodger fan. So your batting average will be much, much better if you just kind of, like Warren Buffett has said, there are no called strikes in investing. So you can just wait. And I think just waiting is the right thing to do for most people most of the time.
And it's interesting. We've had Jack Schwager on the podcast recently, and I've just been reading his new book, and he talked a lot about that. That's one of the main things that a lot of the successful traders he's interviewed have in common, that they're very good at doing that.
I absolutely love his books, and I've read them all several times over. And actually, there's in one of those books, and I was thinking of him when I was just talking about pretending you're not a trader, because I think he writes about a time. That's one of the common denominators in what he's researched, and he writes about a time where he was, in publishing, and he gave up trading for a time until he was, still going through his charts and keeping up, and he saw a chart that looked so, said this is the perfect opportunity, and he put some money to work there, and it worked out great. And he said, just for him, pretending he wasn't a trader for a time was actually a very successful way to go about it.
Yeah. So the obvious issue here is mentally, obviously it can be very difficult to do that because, fear of missing out. And you touched on it earlier that if you're seeing other people make money, you feel as though you need to get involved. How do you approach that problem?
Well, I guess the way that I approach that problem is I just know through experience every time I've put on a good investment. Let's just stick to, I guess, investing right now versus trading.
Yeah.
It's felt very lonely and very contrarian. For example, in 2000, I can't remember, it was 2010 or 11, during the BP Deepwater Horizon spill. It was on the news, literally 24/7 was on CNN, and everybody thought BP was going to go bankrupt. And I remember buying stock, and I was playing in a golf tournament with a bunch of brokers, and they were kind of talking about different market things, and I mentioned BP, and everybody looked at me like the conversation stopped. People put their food down, and they said, "You're crazy to be buying BP." But when you looked at their cash flow, right, their cash flow was like $30 billion a year, and the estimates, the worst, the worst case scenario, the estimates of the worst case were that was going to cost them $30 billion over a number of years to get out of this. And I said, so there's literally no chance BP was going to go bankrupt, but the stock was trading like far below liquidation value. So, that to me, that's always the type of opportunity where when people think you're crazy, that's a great opportunity. Conversely, whenever I've ever felt that, like, I'm jealous of somebody else making money doing X or whatever, I've just seen it over and over and over again that when people act on those impulses, it usually ends badly. And so that's really the thing that drives my understanding about that doing nothing process.
Yeah. And you touched on contrarian viewpoints there. You've talked about the energy sector recently. You think that's setting up to be an interesting place to invest in? You mentioned Sentiment Trader said that the energy sector is now the most hated stock market sector of all time. But yeah, obviously you think this is an opportunity, and are you able to explain what's the appealing aspect of energy at the moment? Sure.
I mean, to me, it reminds me of the gold mining stocks back in the summer and fall of 2015. That summer, the Wall Street Journal, Jason Zweig, who's a terrific writer, and I really like everything he does, but he's admitted he made a mistake in calling gold a pet rock back in the summer of 2015. But it's that type of extreme negative sentiment that creates opportunity. And I think we've seen so much. The Economist recently essentially called the end of the oil age. The last time they did that was 2001, right before one of the biggest booms in the oil market of all time. We're just seeing so many signs that this sector is so hated, and it's gotten incredibly cheap. There are stocks in this sector where, literally they're trading at, and this is why it reminds me of the gold miners. The gold miners in 2015, stocks like New Gold and Gold Corp, and we're literally trading at 50% of their liquidation value. You don't get that type of opportunity in the market very often at all, to where you can literally buy up the whole stock, just sell off the gold mines to other miners and double your money. And that's where we're at in the energy sector. And a lot of these stocks is they're just trading so far below liquidation value. And at the same time, there's a ton of insider buying in this sector too, which is something I've followed for 25 years. And there's literally no other insider buying in the market. There's a fair amount of insider selling broadly, but the insider buying in the energy sector is significant. And so that's, to me, insider CEOs, CFOs saying that the stocks are undervalued, and they think that they have a brighter future than what the market is pricing in.
Very interesting. And when we talk about the energy sector, we're talking about primarily that sector is made up of oil companies, etc. Is that correct?
Yeah, I'm mainly focused on the oil and gas exploration and production companies and the midstream energy companies, so pipelines and those types of things. They all seem to be, there's pipeline companies that are, have 8-10% dividend yields right now. Nobody wants to own them. It's 0% interest rates. You can get 0% on treasury bills, but still nobody wants to buy a midstream energy company with an 8 or 10% dividend yield. It's pretty mind-boggling.
Yeah. And obviously, when they're in deep downtrends, how do you time sort of entries and that sort of thing? Or does it, obviously you don't have to time it exactly right if you're doing investing more for the longer term, but obviously some sectors end up not doing that well when they're in downtrends. And we're highlighting the energy sector, something that's going to potentially looks more interesting than that. That is mainly due to the financials that they have, is it? So we discussed they're trading 50% below value, some of them, and their cash flows, I assume, whilst going down, or I know they're sort of diversifying into other areas, a lot of them, but you see their sort of results getting better in the future, even though oil, etc., is a sort of an asset that might not be as so much demand for in the future.
Well, there's two sides to that question. One, in terms of the downtrends, I started studying, technical analysis about 15 years ago, and I've kind of distilled my focus into momentum, and I want to pay close attention to momentum. So when a stock or a sector has very strong downside momentum, I'll stay away from it. I don't care how cheap it is. What I want to start seeing are signs of that downside momentum waning. So price can continue to decline, but as long as it's not declining at kind of that same rate that it was, we're in free fall decline. That to me is a sign that trend is running out of steam. So that downtrend is running out of steam. So part of that process is looking at momentum in a way that somebody like Michael Oliver looks like. I had him on my podcast, and he does some fascinating and unique work in terms of momentum. And then also, I've been trying to get Tom DeMarco on my podcast. I met him back in 2005, and he's created, a number of indicators that are trend-based indicators. And Tom is a brilliant guy. He's worked for whoever has the biggest hedge fund on the planet. He's Paul Tudor Jones. He worked for Steve Cohen, and now he's started his own kind of research firm. But so that in that terms of that side of it, in terms of catching a falling knife, I don't want to have anything to do with anything that has strong downside momentum. I'm looking for something that has signs of slowing momentum and potentially a trend reversal. But in terms of kind of the fundamental side of these things, they get to a certain price where the margin of safety in them is becomes so attractive that I think it's very difficult to lose money as long as you have a time frame.
So you're just waiting for the demand, people to for them to get hot again, basically, and ride that trend up.
Yeah, and then kind of from a macro perspective too, it's absolutely mind-boggling to me that you have the most powerful entity on the planet, the Federal Reserve, that has decided we're going to do whatever it takes to create inflation. And what's the single sector in the market that's the best way to protect yourself against inflation? It's energy, hands down. You look at the inflationary environments, energy sector, outperforms by 5 to 10% a year in inflationary environments. And so you have the Fed saying we want to create inflation. At the same time, the energy sector is the most hated sector of all time. To me, it just screams opportunity.
Yeah, that makes a lot of sense. Why do you think other people aren't looking at it yet? Why is it so far off the radar of most people?
Well, I think there's a couple of reasons. One, what's the most important, popular segment of the market right now would be tech. But I think a lot of that is driven not so much by passive investing, which is driving it, but we're seeing flows into ESG type of strategies, socially conscious types of things. And so it's not just passive investing, which would on its own, be an anti-energy strategy, because passive is pro-momentum. And so things that are going up get more money, and things that are going down get less money when money goes into the indexes. So that's just a bad thing for energy. But when you have money going into ESG, essentially out of actively managed funds into ESG, most of those ESG funds own no energy. So this is the trend that people think that, I'm investing in socially conscious companies, which when you look at the holdings, a lot of these ESG funds, it's a joke. I mean, it's, you can't be buying a lot of these stocks that are treating their employees poorly and whatnot. So ESG is kind of just, to me, a popularity momentum trade right now. People are buying it because it's done well. People are buying it because it has a bigger allocation to the FANG stocks than passive funds. It's really kind of a tech momentum trade. But the other side of that is energy, which is dramatically underperforming, because it is kind of the anti-ESG trade.
Yeah, it's very interesting. And you talked about momentum, and you use that as a good indicator of, you want to see that sort of the steam coming off. How do you track that and analyze that on these charts?
Well, I mean, there's super simple ways on, technical charts. You can look at things like RSI and whatever. People traditionally use RSI as like an overbought, oversold. But the way I think probably RSI should be used is when you have really strong, RSI, that overbought signal is not a bearish signal at all. That's a sign that something has really strong upside and is likely to continue higher. So that's kind of what I mean in terms of momentum. Somebody like Michael Oliver has distilled it even further, where he looks at price relative, relative to its 10-day moving average, price relative to its 40-week moving average, just different types of moving averages. And when you see those kinds of extremes above and below a moving average, that's a sign of strong momentum too. So, when momentum is very strong, it typically continues in that direction. Is something that, probably one of the most basic things that I've learned from technical analysis, and really has helped me from, to avoid, value traps and things.
Yep. And what do you think is the best way to get exposure to this sort of sector? Are you looking at funds like spider funds of the energy sector, or individual stocks, or?
Both. I mean, I think for some investors, ETFs are probably the best way to go. In terms of that, the thing with XLE, which is probably the big energy ETF, is that I think about 50% of that fund is just Exxon and Chevron. And so if you like those two stocks, XLE is probably a good way to go. But to me, you can buy something like just the pure oil and gas producers ETF. And that's going to be probably a little bit more leveraged to those companies that are more exposed or leveraged to the oil price. And so I think if you wanted a more pure play, probably focusing on the oil and gas producers is better. There's also a few individual stocks I'm looking at that have had terrific insider buying.
Yeah.
Continental Resources is one where Harold Hammond's been buying tens of millions of dollars worth of stock. He's one of the most successful, founders in that space.
Yeah.
And when he goes in and buys 50, $60 million worth of stock and says he's going to continue buying, to me, that's a very strong sign of confidence that his shares are undervalued.
Yeah, really interesting. And I'd like to go talk about his value versus growth argument again, because I think that's that one we touched on, but it'd be good to go deeper into it. You had an article recently saying, is value really dead? What's the argument for value at the moment? Are we talking about something similar again? It's the contrarian trade. Is that why it offers opportunity?
Well, so there's, I wrote that post because I really wanted to distinguish between traditional value investing and quantitative value. So it's become much more popular just because ETFs are popular and all these things to, use some type of quantitative value. So we're just going to buy the 10% cheapest stocks in the market or something like that. But as Mike Green has pointed out, when you're doing that, you're essentially betting against passive investing because those 10% cheapest stocks in the market are suffering from that kind of anti-momentum of money moving into passive indexes. So money moves into passive and more money goes into those stocks that are rising and becoming bigger in terms of market cap, and less money goes into those stocks that are falling, becoming a smaller part of the index. And so saying that I'm going to buy those stocks that are kind of those anti-momentum trades is essentially what quantitative value is. And that's a very difficult thing. I personally, I don't consider quantitative value to be real value investing. I think when you study real value investing, you have to do security analysis on individual stocks. You have to determine, like Ben Graham taught, is my principal protected? One, am I going to get a decent rate of return? Two, and there's no way of doing that on a group of stocks when you're just buying a segment of the market, no matter what. I mean, because you actually look at the value segment of the market, and it's not cheap historically. And so, I mean, hypothetically, you could say I'm going to buy the 10% cheapest stocks in the market. Well, if that decile of the market is trading, 100% above its, historical valuation mean, then you're not value investing, but you're still buying expensive stocks. And so, I do think traditional, we've said value investing has been hammered. It's been the worst performance. I saw it in Financial Times today. It said worst performance in 200 years for value investing. And that value segment of the market, yes, that might be true, but if you're a traditional value investor looking for those opportunities that pull your cash off the sidelines, that because they're so attractive. Over the last 10 years, there have been wonderful opportunities to put money to work in value, in these types of opportunities, but they haven't been in a quantitative way. It's been in a much more individual, microeconomic way.
So you're saying that the sort of more traditional value investing, there has been opportunities over the last 5-10 years. Or are you saying that there are opportunities that are coming up soon, or?
It's really hard to say. I mean, I think probably the value decile will begin to outperform. I've seen some interesting research that shows that when you're heading into recession, value dramatically underperforms, and that's what we've seen. We went into the worst recession, since the Great Depression, and value led the way to the downside into that, as a decile in the market.
Why is that?
Well, it's because a lot of those stocks are cyclically sensitive. Mm-hmm. And you look at the stocks that have performed well, all these lockdown stocks, Zoom and Netflix and all these things, in no way can they be considered value stocks, but they've actually benefited from the pandemic. So there's also a unique thing at work going on right now where the situation, the environment that we're in has exacerbated this value, because traditional bricks and mortar companies, especially airlines, cruise lines, retailers, especially hit hard as a part of the pandemic. And so But a lot of research shows that coming out of recession, value dramatically outperforms. Dan Rasmussen put out an email over the weekend showing value dramatically outperforms coming out of recession. And why is that? It's because the earnings of these companies rebound so strongly that the earnings are growing faster than the growth stocks. And so value's outperformance coming out of recession is very, very significant. So I think we're probably on the verge of a real strong value trend. And I think that's what we're seeing over the last couple of months is we're starting to see some of these growth names struggle and some of these value sectors really start to try and bottom.
Yeah. Did we see this sort of same thing happen with value back in 10 years ago, the sort of financial crisis?
We didn't really see it. Well, I guess we did. Yeah, we saw that those stocks get hammered into, especially bank stocks, right? Got absolutely crushed going into the.
But they've never really recovered, a lot of them. Well, at least in the UK. I can't.
Yeah, you're right.
Well,
that sector has kind of been permanently damaged, by ultra low interest rates. And different things. And then also that a lot of those companies just took such huge hits in the financial crisis that they never really came back. But to me, this value rotation feels a lot more like 2000. And we saw, big value shop close up shop last week, decide they're closing. And that's very reminiscent of what, Julian Robertson closing his fund in 2000, right at the peak, just when value underperforms so for so long by so much. It's really tough to keep investors in your fund. And this comes back to this thing we were talking about at the beginning. And so, when you see a lot of these things shut down, it a lot of times can be kind of one of those hallmark moments of, that the turn. And again, in 68, I think was when Warren Buffett shut down his partnership, saying that, there's just not enough value opportunities and too many people are speculating. And I just don't know how to profit in this environment. So, Buffett called it quits in 68. Stocks went from 68 to 82, went nowhere. And same thing in 2000. Julian Robertson, famous value investor, called it quits. Stocks went nowhere from 2000 to 2013. I think we could be kind of witnessing another similar time where you have big value investors shut down today, and it could be just on the very beginning of a value, that kind of rotation trade into value out of growth.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
So in terms of your outlook for the US equity market going forward, if there is, are you sort of anticipating stagflation scenario, but potentially value and to outperform?
I do think that's right. I do think probably value is probably going to make a comeback. You look at bank stocks again are trading at 6-8 times earnings. Energy stocks are incredibly cheap. Those are kind of when you look at value, and this is part of my problem with quantitative value. You look at a lot of these quantitative value funds and they have no exposure to energy. And I just don't understand that. So, it's really hard for me to make, it's much harder for me to make a call on will quantitative value come back or will, the energy sector or these things. To me, like I said, there's been terrific opportunities for disciplined traditional value investors over the last, 10 years. So I think probably the way to go about playing this is to just do that rather than try and wait for a turn in quantitative value.
Mm-hmm. And globally, do you see US equities have had their sort of day in the sun so far, and maybe emerging markets become more interesting in the future, especially if we're going to see the dollar go down? Where do you, because obviously US, the last 10 years, it's been the place to be, hasn't it? So do you see that changing going forward?
Absolutely. I think, the US equity market is probably the most overvalued equity market on the planet. And every other market is relatively cheap to one degree or another. So, I think emerging markets definitely look cheap. And if you are bearish on the dollar, I think those two things, you have the combination of cheap equity markets and currency tailwind going forward means you probably want to own some emerging. And like my friends at GMO have pointed out, if you apply a value discipline to emerging, I mean, you're looking at probably really good returns over the next, I think they use a 7-year time frame. I think in terms of real returns, they forecast negative returns for almost every asset class except for emerging value. I think they're putting about an 8% real return on emerging value for the next 7 years. So that is one area where there is a great deal of opportunity, I think. But probably, it just for U.S. equity investors, I think home country bias today might be more dangerous than it's ever been because the U.S. equity market has outperformed for the last 10 years more to a greater degree than it ever has been or has in history. And so in terms of currency and relative valuations, I think you definitely want to be diversified overseas right now.
Mm-hmm. And are there any places in particular in emerging markets, et cetera, that are sort of appealing to you?
Well, this is kind of controversial, but you look at what makes up an emerging markets fund, and it's like 50% China typically.
Yeah.
And so you have to be bullish on China if you're bullish emerging markets. And so why would you be bullish China? Well, everyone says, well, they've taken on so much debt. Well, the U.S. has taken on a massive amount of debt, and we don't have the ability to grow our way out of it like China does. China has the ability to grow their way out of a lot of that debt. And in China, so China just still has a ton of growth ahead of it. The stocks are very cheap relative to the United States. And, it's just tough this is the problem. And I think Meb Faber's done a lot of good work is you look at, okay, what are the cheapest countries around the planet? Because they typically outperform over the next 1, 2, 3 years. But a lot of times when you look at them, it's like Turkey. Several years ago it was Greece. And you're like, oh my, I can't invest in Greece. Are you kidding me? And the price gets so cheap though that, Greece goes up 150% over the next 2 years. And so, I think that's probably what a lot of people are really uncomfortable doing, but they should be doing is looking at what are these cheap markets around the world. And yeah, I mean, China is one of them. And people say, well, the trade war and all this stuff. And that's probably why China is relatively so cheap right now.
Yeah. Are you a believer in this sort of, it appears to be the contrarian trade, like going where other people haven't sort of, they're not the hot sector, and looking for where there's value where people aren't looking yet, because if as soon as it does become hot, there's disproportional potential returns there. But obviously against the sort of, if something is trending positively, it can continue for a while, right? Just like we've seen a 10-year run in US equities. What's the strategy you prefer to sort of go with there?
In terms of overseas markets and things?
I suppose just more fundamentally, investing where people aren't and trying to or going with the flow where,
Right.
Do you see what I mean?
That's a great point, because contrarianism for contrarianism's sake is usually a bad idea. The crowd is right most of the time, and that's what I was kind of talking about with that momentum side of things. It's only at turning points when the crowd is wrong. And so I think you have to use that contrarianism very selectively. As one of my favorite quotes is from Howard Marks's book, The Most Important Thing. He says, to generate outsized returns, you have to have a non-consensus view about value, and you have to be right. And that's important. A lot of people have non-consensus views, but they're not right because the consensus is right most of the time. And so I think that's an important thing to think about is okay, I have a non-consensus view, but how can I have to understand the consensus as well as anybody, and then understand why that's wrong in order to come up with a good investment thesis. And so I think that contrarianism is probably too simplified of an investment strategy on its own. It has to be paired with other things.
And do you typically wait for some sign that, because obviously You can be, I think it was Jim Rogers we had, in that you can be in the right trade, but obviously the timing is the other thing that's so important. It's sort of what we're discussing now. Do you wait until there are solid indications that money's moving that way? I mean, you talked about insider buying, but how many other things do you need to make it sort of like, okay, this actually looks like, the money's going to start flowing this way, and believe what I'm believing?
Yeah, I mean, it probably would be really smart of me to wait until price starts to validate my opinion, but I usually can't resist investing before then. To me, there's the three things that I look at, really four. And my friend Todd Harrison has really kind of pounded the table on this, that it's, fundamentals, sentiment, technicals, and macro are the kind of the four things you want to line up. And so fundamentals, is it cheap? How cheap is it? Has it, and to me, I like to look at history. Is it cheap relative to its own history? You can see a lot of stocks and sectors, that trade maybe between 5 and 10 times enterprise value to EBITDA, or whatever kind of indicator you want. And so, kind of when it gets around 5, it's pretty cheap historically. In terms of sentiment, we've talked about that a fair amount. How do people feel about this? And I want to buy things that I think are extremely hated or absolutely ignored. So technicals we talked about too. I'm looking at momentum mainly, and I want to see signs that momentum is really tailing off. And a good sign of that, and this is a lot of traders told Jack Schwager this in his books, is that when you see a stock or a currency or commodity or whatever it is, when there's bad news that hits the tape and it stops going down, the price doesn't go down anymore, that's a really strong sign that a lot of the negativity is already in the price. And so that's kind of the thing in terms of momentum that I want to see, is just bad news hitting the tape, but it's not making new lows. To me, that's like, okay, well, what can make it break down to new lows if already all this bad news isn't able to? So to me, that's a key sign. I want to see something like that. And then in terms of macro, you have to have a macro thesis. And we talked about that as well for in terms of energy. It's the Fed's going to create inflation. They have to in order to pay for all the debt that the country's taken on. And in that process, you're going to want to own things that are protect you against inflation. And just by chance, energy is the best way to do that. And it's also the cheapest sector in the market right now.
That is crazy. And do you think it's inevitable that inflation will come based on what's happened so far? I know they're trying to do that, but we've talked about stagflation. There's other things at work.
Yeah, the Fed can't do it by themselves, and that's obviously why we haven't had it. They printed so much money for 10 years. But I think it's the attitude in Washington that changes. The fiscal authorities have the ability to create inflation. If they go, and I think what we're going to see, no matter who wins the presidential election, is some type of infrastructure plan. We're going to have a weak, like I said, stagflationary type of economy. I don't think we're going to have a very strong economy coming out of the pandemic generally. And that's what happens a lot of times when you just take on too much debt in terms of companies. They just don't have the money to spend coming out. And so it's going to be a weak recovery. So I think the government, no matter who's in charge, is going to try and pursue some type of infrastructure bill. And that's where you get trillions of dollars put directly into the economy, into the hands of workers and people who are going to spend it, and the Fed monetizing, being forced to monetize that debt. That is a recipe for inflation. So I think by the time we see an infrastructure bill announced, we'll already see the inflation trade starting to take off.
Interesting. And I wanted to quickly talk about now, there's a really interesting article that you had about Tesla and Goldman and SoftBank as well. Are you able to, it's about the recent sort of explosive price rise in Tesla related to the options activity that's been going on. And you did quite a lot of research into this. Are you able to sort of go into explain a bit about what you found?
Sure. I mean, a lot of what has gone on with the options market is certain people have realized, and this is retail traders, but obviously more than just retail traders, have realized that if you buy enough call options, you're going to force the price of the underlying to go up. And so, just take Tesla, for example. If you're buying someone's buying hundreds of thousands of call options every day, the market makers the dealers, options dealers, are going to be short calls. And so how do they handle that? Well, they go buy Tesla stock, common stock, to hedge their short call position. And the more Tesla stock goes up, the more of it they have to buy to hedge. And so what happens is you have a lot of this call buying makes the stock price go up, makes hedgers, through hedgers buying. And so it becomes like a virtuous cycle. And I think it's not just retail investors that have realized this, and has been written about on the Wall Street Bets message board for months. I mean, really since the beginning of the year, where these kind of groups of traders have decided, okay, today let's buy Tesla options. We're going to push the price up. Goldman Sachs and Morgan Stanley, the two of them have lent, money to Solar City. They've lent money to Elon Musk against his Tesla shares directly. And, Tesla's been one of the biggest beneficiaries of this trade. And so, I obviously, I wrote this. I don't have any evidence to suggest that this has happened, but it certainly would make a great deal of sense for somebody like Goldman to just buy a bunch of Tesla calls, because then you essentially guarantee that your debtor that you've lent money to will be able to make good, will be able to pay off all their debts. And so Tesla's been able to sell stock in the open market. Elon Musk's shares have, appreciated. So all those loans are going to get paid back. And, Goldman has come out and said they made $100 million buying Tesla options. And so to me, this just strikes me as, classic, Wall Street opportunism. And obviously there's no evidence that Goldman did this on purpose. But when they say they made $100 million trading Tesla options, and then they have all these loans out to Tesla, Solar City, Elon personally, seems like there's a huge conflict there.
It does indeed. And what do you think? I mean, this sort of options activity is unheard of, and especially with this sort of scenario. Are you able to hold the price at these levels? Or does it require options activity to continue at these levels? What do you think's what's going to happen in the end?
Well, I think we saw it, like I mentioned, it was in late last year where we saw this option activity really start to take off, where it was Wall Street Bets traders saying, hey, let's do this in different calls, and we saw kind of a blow off into February. And I think part of the reason the downside was so dramatic in that crash, that February-March crash in the market, was what happens when all these calls expire worthless. Well, market makers are left with hundreds of millions of shares of stock that they now have to liquidate because they no longer need to hedge because their short call positions expired. So as long as this call buying keeps going, then you're forcing the market makers to stay long. But as soon as this call buying slows down or can't be perpetuated, and I think we're seeing this over the last couple of months, why the market can't power higher, really, you could see a liquidation too. And obviously that's not the only factor that would cause another steep sell-off, but it can certainly exacerbate a sell-off when prices start going down. Hedgers don't need to own as much stock. So even before those call options expire, they'll start selling off common because they don't need the hedges as much when the prices start going down. So it really this is just one of these strategies, and there's a lot of them that we've seen just kind of rise in the last 3 to 5 years that exacerbate the upside and exacerbate the downside. And you look back to January of 2018, and we had the Volmageddon crash. I think that was February of 18. Then late 18, we had another kind of crashing type of a market, with a rally to new highs, and then a big, even bigger crash in February and March. I think this rising volatility environment over the last 3 years is going to continue because of the more esoteric strategies that are being employed.
Yeah, it's really interesting. It's it's not been explained to me in that sort of manner before, and it's really the amount of things that are going on influencing price at the moment is crazy, and scary as well, I suppose, because how do you play? Do you stay away from stocks that are getting manipulated so much? Is that like a warning signal, you think, or are they just opportunities, if you know how it works, that you can take advantage of?
Well, I think what I'm probably more interested in than kind of betting on quantitative value making a comeback is betting on some of these stocks that have been the speculative favorites, been pushed up by the option fund, betting on them kind of reverting to some sort of mean, which in a lot of cases means a lot of these stocks, just like we saw in the dot-com bust in 2001-2, a lot of these stocks can go down 90% easy. I mean, famously, Scott McNeely said that investors were crazy to pay 10 times sales for his stocks on Microsystems in 2000. Well, you got so many stocks trading at 20, 30. I think Zoom trades at 100 times sales. There are a lot of these stocks that when these trades revert, there's going to be a ton of downside in some of these growth names. And so I do think there's opportunity there. And
why hasn't that happened already, do you think? It's just there's the demand's still supporting it. I think I saw macro trade, record inflows basically into the tech sector, etc. still. Is that what's supporting price?
Yeah, well, there's still just a speculative fever. That's kind of, I think it's starting to tail off. But
it does feel like it.
Yeah, I mean, and I think that's, really I think the peak of that speculative fever was back in June. When you saw a lot of those that was kind of the peak in momentum for the rally. It's kind of the way I look at it, was back in June. So, that was kind of, to me, the peak in that speculative fever, and it's starting to tail off. But there's still tons of call buying. You mentioned SoftBank is still buying billions of dollars of common stock and billions of dollars in call options, which is astounding, right? I mean, essentially, they've realized we can go raise billions of dollars in markets and just use that to speculate in the public markets and, make 2, 3, 4, 5 times their money. It's very reminiscent of, the bubble we saw in Japan in the late 90s, where you had companies investing their cash in stocks because, they knew that, everybody thought you had to do that in order to make money. SoftBank is kind of manufacturing its own profits right now, but at some point, the dry powder, and the cash to keep that going, and the will to keep it going will evaporate.
Yeah, very interesting. How much longer do you think it can be supported? Because some of these things can last long. A bubble can last longer than people can think sometimes. And we're saying momentum's declining a little bit, but if things start breaching all-time highs again, you could just have another sort of push again higher. How do you tell when these are sort of times to pull out and stuff like this?
Well, I think it's. You're absolutely right. I mean, these things can go on, seemingly indefinitely. And it's really just paying attention to, I think, those technical signs that really help me try and understand. And the only reason I would be trying to short anything right now is that these signs of momentum are really waning in a lot of areas, individual stocks, in the broad indexes. Like I said, it kind of works the opposite for me in terms of short selling. If there's strong upside momentum, there's no chance in hell you're going to get me to short something. I'm only going to look to short something if it looks like that, it's had very strong momentum, extremely overvalued, and starting to wane and potentially roll over. And then once I get that confirmation that it's rolling over, that's really what you want. My friend Bill Fleckenstein has said, one of the best short sellers, maybe the best short seller I've ever known, is that he looks to shoot stocks in the back. I want to wait until they've rolled over, and when they're really starting to get that strong downside momentum, that's when you really kind of have a heavy short position. And otherwise, you need to be very, very cautious in terms of standing in the way of any of these things, because you've seen so many of them go up 5, 6, 7, 8-fold in just a matter of months. So I mean, you just can't get in the way of that.
That's amazing. I just wanted to wrap up the podcast. We do this quick fire round, which is basically there's 6 questions here, but we're only looking for very short answers for each one. Is that right if I just roll through those now?
Absolutely, let's do it.
The first one is top tip for your younger self.
Go to work for somebody you admire. I worked for somebody that I didn't admire too much, and that was a learning process, but I think it's better advice to go work for somebody you admire.
Very interesting. Let's find your mentor. Is that what you're sort of implying, especially at an early age?
Yeah, and not just in terms of their skill and success, but in terms of their personal values and all that.
Okay. What do you believe your source of alpha is? If you could narrow it down to one primary thing.
Oh man, it's tough. I think honestly, I mean, and probably most people feel this way, but I do feel like I am a true contrarian. I will go in and buy things. One of my favorite chapters in Market Wizards was the Jim Rogers chapter. And you listen to Jim Rogers and he talks about wanting to invest in North Korea, right? He talks about the most contrarian ideas you've ever heard of. And, you know, a lot of people think they're contrarian, but you're only contrarian if everybody thinks you're crazy. And so I'm willing to go instead in those areas where people think I'm crazy.
Favorite book? It doesn't have to be trading or finance.
Oh, man. Well, my favorite trading book I just mentioned is Market Wizards. The Schwager series is just so valuable. I go back and read them over and over again.
Awesome. Where or who do you go to for market insights, if anyone?
Well, I've named a ton of people during this show, and I really love to kind of highlight them. And that's why I started my podcast, really, is to try and highlight the people who I find offer unique insights. And Twitter has been very valuable for me. A lot of those people that I've had on my podcast are people I follow on Twitter. And I only follow them because they provide such unique insights. So I would suggest, just those people that I've highlighted in those ways.
Yep. I've got favorite place you've traveled and why.
Favorite place I've traveled. I don't really travel much. I'm kind of a homebody. I actually hate travel. I'm really kind of I don't like crowds. When I was a baby, I used to throw up when my mom would take me to crowded places.
Okay.
And so probably I like to go to the Oregon coast, incredibly remote beaches. There's no development and it's just beautiful, wide open, natural spaces.
Awesome. That's great. And finally, top prediction for next year. We've discussed a few of them here, but I mean, maybe we can narrow it down to one if you're happy doing that.
Yeah, I think the one that I have the most confidence in is energy is going to outperform dramatically, and it might come from the rest of the market declining and energy, not declining as much. But I do think energy is going to outperform dramatically. Yeah,
really interesting. Brilliant. I mean, it'd be great to finish by if you could tell people where the best places to find you, to follow your commentary, etc.
Yeah, absolutely. I mentioned Twitter. I'm kind of a Twitter addict. I do a ton of reading every morning, and I usually tweet out most of the good stuff that I read. So it's like 8 or 10 articles, maybe a morning. And if that's so, you can follow me on Twitter. It's at Jesse Felder. And if that's too much for you, I put together like a Saturday morning email with the 5 things during the week, whether it's a chart or an article that was, I found the most interesting. So you can sign up for that free email newsletter at my website, which is thefelderreport.com.
Amazing. Thanks very much, Jesse. I've really enjoyed that. Really gone into some sort of areas that I've not talked to other guests about, and it's been really interesting to do that. And also, I mean, I think the opportunities that you've surfaced there definitely should be on everyone's radar. They can go and research themselves now. But great, thanks very much. And I hope to work with you again soon.
Well, that was a lot of fun. So thank you much for the invitation. And I had a great time.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.